Okay. All right. So why don't we start by Alan telling us in a minute or two what's your day job and why you started a Substack newsletter.
Sure. Yeah, I run a government contracting firm in DC. So we're beltway bandits, just like a lot of other firms in this town. But I got increasingly interested as I was running the company and as it grew, and as I read more about the ideas around capital allocation that come with owning a company as you grow. And I've always been sort of a policy, I worked on the Hill for many years. And so I've always been interested in foreign policy and policy in general. So I started the Substack just to kind of get the ideas that are in my head. It's really how I think, is by writing my Substack. And I over time, it's really converged around a couple of different themes, which are how do you allocate capital, right? So if you have money, what do you do with it? And that, to be honest, whether you run a business or not, you're allocating capital every day if you have any kind of investments. And then trying to understand, I'm a Gen Xer, so I grew up in the my formative years really were in the 90s. And I feel like the entire world has changed around. And we're experiencing a rapidly changing environment. And so it's sort of like the new rules was kind of, how do you run a company and how do you allocate capital, and how does the geopolitical and other situations around that impact those two things? So it's kind of an evolving thing as I go forward, but that's sort of the background.
Okay, and kind of what struck me is one of your themes is investing when there's repression, right?
Yeah.
Okay, so do you want to give us what does repression mean in this context?
Yeah. So what really struck me in the last couple of years has been, obviously we all survived this pandemic because we're on this webinar, so we got through it. But I think it profoundly changed what's happening as far as investing in society and other aspects. And really what struck me was we had, the last 10, 12 years have been this hyper deflationary time when we've seen the costs of doing business overseas, labor, everything was going down, right? And we saw crazy bubbles being formed as a result, and low costs of capital. And what I really saw happening during, obviously there was deficit spending happening before the pandemic, but we went into kind of a hyper mode when the pandemic happened. And I think, many of us on this call were around in 2008, 2009, when everyone said inflation would go crazy because of the Obama stimulus. And then because of, because of the quantitative easing programs of the Fed, and none of that really happened at that point. But what we saw in the pandemic is a massive fiscal stimulus, right, from the Treasury, from appropriations rather than quantitative easing. And then, of course, we also had supply constraints and other things like that. And we saw a blowout in budgets. And of course, as a result, we finally saw inflation that no one, certainly at my age, had ever experienced in their adult lives. And so what I started thinking through is this just, what I think the markets are saying today is this is a blip. It's, you know, it's almost the transitory sort of narrative continuing that the Fed was using a year and a half ago. Um, but I felt like something fundamentally had changed. That given, you know, I'm a business owner, I hire on a daily basis. There are no workers left, right? We are stealing workers from other people at this point. And I started looking at a situation where I don't think this inflation narrative is going to go away with one set of Fed increases in interest rates. So then that drove me to start who is talking about this. And you know, Arnold, you did a interview with Lynn Alden last week. I've been there's a Scottish investor, Russell Napier, and a few others that I started seeking out and seeing that you know, what happens in these kind of environments is, you know, we have an emerging narrative maybe on the right a little bit of hey, we need austerity, but austerity is not going to cut it. Like no one's going to vote for that. We have a millennial generation coming up that isn't interested in that. We tried it with sequester back in the 2010s, and it's not coming back. And you have both parties now saying we're not cutting entitlements. We're taking, you know, China's, we're fighting a proxy war in the Ukraine. China's an increasing threat, so we're not cutting military spending. So really, when you start thinking about it, there's no way we're going to withdraw fiscal stimulus on the federal side. Taxes aren't going to increase. So I started looking at what's going to happen as a result of that. And if you look at what Lynn Alden and some other people are saying, is we've had a similar circumstance to this before, and it really wasn't, you know, the 70s were sort of like this, but we didn't have the high debt levels in the 70s that we have today. So what is the analogy? And it really is the 1940s post World War II. And the way we dealt with our high debt levels was not through austerity. Certainly we restrained spending, and I think we will going forward. We're not going to have additional stimulus that we've had in the last couple of years. But essentially what we decided to do is screw over the debt holders and advantage you know, the workers and the government. And I think we're going to do something similar. So financial repression is essentially, we are going to allow inflation to stay relatively high. I mean, I think we're talking about a bound here. Like right now, we're in a state where the Fed's trying to keep us from having out of control, you know, long-term inflation of 7, 8, 9%. That will not be acceptable. But at 3 or 4% or 5, I think the Fed's going to be okay, and we're probably going to keep rates at 3% and have that 2% differential deflate our debt to GDP ratio over, you know, the next decade. So what I started seeing is our government has to deflate our debt away. It can't do it through austerity. It can't do it through tax increases. So really the only way is to steal money slowly from old people and the Chinese. And those are the people who own treasury bonds.
So, yeah. Can someone raise their hand who wants to define the term negative real interest rate? Maybe Steve Winkler, do you want to give us give us the definition of that?
Yeah, I can try. So basically, when your interest rate minus the rate of inflation is negative.
Okay, so Alan just gave a hypothetical example. If we run inflation at 5% and the interest rate is 3%, then the real interest rate is negative. Now, I'm old enough to remember when that was crazy. So I'm old enough to remember the last time inflation was high, interest rates were high, and interest rates got higher than inflation, and that's helped knock inflation down. I'm also old enough to believe that negative real interest rates, which people have more or less got used to in the 21st century, are really distortionary.
Mhm.
If you buy a house at a negative real interest rate, it's like you live in the house for free. If anyone needs an explanation, that feel free to raise your hand. I'll be glad to do that. But you basically live in, it's a borrower's dream world. Basically, people are paying you to borrow money, and it distorts all sorts of decisions. It has led over the past, decades to what people refer to as the everything bubble. No matter what you bought, if you bought bonds, you did well. If you bought stocks, you did well. If you bought real estate, you did well. If you bought Bitcoin, you did well. It was the everything bubble. And um, a thing that, so people have forgotten what a sort of moderate to high interest rate and inflation environment looks like. And one thing I want to remind you about is the tax distortion. So negative real interest rates, when the interest rate is 0 and inflation is 2, work differently than when the interest rate is 3 and inflation is 5.
Yeah, it was a point.
In part because the tax distortion. So if you borrow, you get to deduct the nominal interest rate from your taxes. And if you save, you get taxed at the nominal interest rate. So what that means is that the real interest rate is even more negative for the borrower and even more negative for the lender on an after-tax basis. So that is even more distortionary. And what that says, so as you kind of ratchet up the inflation and interest rates, you're getting a bigger gap. If you have a negative real interest rate to start with, you have a bigger gap on the after-tax basis. So back in the 1970s and 1980s, you really had, if you wanted to reverse the negative real interest rate and the distortion and cut down on the bubbles and inflation, you had to raise the nominal interest rate way high. So we were talking 12, 18% interest rates. And, you really have to do that if you want to do that. So back to this issue of repression. So what Lynn Alden was referring to and what Alan Pentz is referring to is the way I put it is you as a corporate treasurer or as the manager of your household finances want to have your funds match or keep up with or stay ahead of inflation. And the government is out to stop you from doing that. It needs you to fail at doing that because, as Alan said, the way the government is going to keep its debt to GDP ratio from growing to explosive levels is it's going to erode your savings by having you put money into government debt at, let's say, 3%, running a 5% inflation rate. So it's a tough investment game that you're playing. I really wish that austerity were on the table because I think that's the only way to, deal with this misalignment of ordinary savers and government.
Well,
So back to just one second.
Yeah.
So back to the 1940s. A couple of things were different about that. Several things. One is that the major deficits were behind us starting in 1945. The war was over. Government spending went way down. I mean, we had austerity, by today's definition, unbelievable amounts of austerity. And, the Keynesian economists were forecasting a deep recession, which didn't really happen. the other thing, so we had genuine austerity. The other thing is we had a very, you wouldn't believe what the financial system looked like compared to today. It was very simple. It was not globalized. It there were no large banks in the United States. There were none of the fancy financial instruments. There were no money market funds. There were deposit interest ceilings. You couldn't pay, the government said you couldn't pay any interest at all on checking account, and saving account interest rates were regulated. So very different financial environment. I mean, it was, kind of by nature sort of repressive. And then very importantly, the Fed was not independent for the first 6 years after the war. And so the Fed was ordered to keep the interest rate low. So you had a tremendous amount of financial repression between the simple financial system that didn't give the average person much choice and the Fed not being independent and forced to keep interest rates low. So we did have some inflation. It wasn't extravagant, all things considering the situation, and we had this short-term austerity of decommissioning 10 million soldiers and cutting the defense budget, which had been a huge proportion of GDP, down to a much lower number. And then we had a president, Dwight Eisenhower, who believed in balancing the budget and succeeded if you actually used the current accounting rules. He succeeded. The accounting rules at the time, there was a slight deficit, but by today's things, it was a surplus, and it was especially a surplus if you took away the interest payments and just looked at non-interest spending. So the austerity continued through the 50s, and the bottom line is there was a big reduction in the debt to GDP ratio. So what's different now are two things fundamentally. One is that the big deficits are in front of us in the form of Social Security and Medicare unfunded liabilities. So there's no, automatic path for the debt to go down. In fact, CBO projects it to go up. And we have a much freer financial system at the moment. So
key distinction.
So yeah, at the moment. So there's a real question of how the government is going to maintain a situation in which it can borrow at rates that are below the rate of inflation for a long time. And that leads to this term repression. So we can expect, I think, a lot of efforts at financial repression. And I see that as channeling people's money into banks and then keeping the banks from paying an above market interest rate, and then channeling the bank funds into government debt.
Yeah.
So you see that coming as well. I mean, that sounds like what Lynn Alden sees.
100%. Yeah.
And so then the question is, what do you do as an individual when you've got the government against you in that way? So tell us how we're going to get around this as individual investors.
Yeah, so I think very good description, Arnold. I think 100%. What we saw in the last week was the opening cannon, starting gun of the problem with the banks, and the government is going to have to turn them into regulated utilities, right? That they're going to force more and more money into at repressive rates. So we're going to see, I think, the regulatory independence of first the banks, and then the Fed as diminishing. They essentially have to. There's no way that they can get through this without doing that. So I think that's that is 100% what's going to happen. One thing I did want to just quick tangent on the negative interest rates. So although rates are still negative, right, and probably will be throughout, according to financial repression, I do think there's an adjustment in values in assets that has to happen that has not happened yet. That's a result of going from, negative interest rates at, or, real or nominal interest rates at whatever it was, 1-2% to 4-5, blah, 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 that still has not gone through the economy. So
it just hit the banks.
Right, it just hit the bank.
And it
right?
sort of hit mortgage borrowers, but where else does it have to hit?
A little bit, but I just read a piece last week about the private markets. First of all, I don't think the public markets have fully digested it and where it's going to get to.
By the public markets, you mean the stock market?
Stock market. And, I think we've got another down leg coming where we're going to be at 5.5. If the Fed has any independence left, we're going to be at 5.5% on the Fed funds rate at some point in the next few months, given where inflation is.
And so that I think that the markets are hoping the other way right now.
Of
right?
course they are. Of course they are, right? They think that we're going back to the old world. We're not, in my view. And I think private markets are so much far behind that. I mean, I do a lot of investing as a limited partner in real estate. I've looked at private equity investments. They are in delusional territory at this point. And those groups are going to lose most of their capital, I think, going forward.
So
they're still at cap rates that make no sense, given you can go out and buy a treasury bond for more than the cap rates being offered, even in office, at this point. And everyone knows office is gone, right? So the private markets are completely out of sync.
So you mean all these unicorns aren't worth what the
unbelievable, right? Yeah, no, I think the tech industry is in for the VC industry is in for a long-term downturn, much longer than we had in the 2000s, and after post great financial crisis. I think private equity is a doomed asset class right now. I think private real estate is in a place where I wouldn't even touch it with a 10-foot pole.
Not even like multifamily. I mean,
multifamily is disastrous right now.
Why is that? Because my sense of it is that from a population to housing start ratio that we're way behind in terms of building from
right. So what I'd say is, first of all, we've had an immense run up in multifamily values over the last 3 years. As an LP investor, I've watched it happen. The terms that were coming out, and even this time last year, were ridiculous for investors, and that was driven by the rent growth post the repression of prices during the pandemic, and some of the movements around the country as a result. But what's happened now is you've had a massive delay in completion of projects. So this year, I believe we're on track to have the largest delivery of multifamily projects since 1973, the year after I was born. So, I mean, it's been a while. I'm not super old, but I'm not really young. So it's been a while since we've delivered this amount of product into a softening rent market. So obviously everything's regional, and maybe X region is going to not experience huge price downturn, but across the board, I think on average.
So I shouldn't buy into the Navy Yard building boom.
Well, I can't tell you about Navy Yards specifically. I just tell you on average, I think that we are experiencing softening rents and a massive delivery of new multifamily. And we have a lot of operators that are on, construction loans, temporary adjustable loans, balloon loans. We're going to see, and, obviously, Arnold, that, as Milton Friedman said, monetary policy has long-term and variable lags, right? So I think we're seeing that, right? And
Well, gee, if these guys need extended loans, they're going to go to these banks that have no liquidity. So that's
right,
going to be
we're going to go to
fun.
all the regional banks that are killing it right now, right? So get a bunch of loans. So I think we're in trouble. I think a lot of these private, I think that the public markets have reflected. I don't have a percentage. Maybe it's 50% of the problem. Maybe it's 60%. The private markets have reflected almost none of it.
So, all right. So you still haven't told me how I can win this game against
How you can win this game. So, I mean, it's something I look at every day, right? So I think the game right now is short-term treasuries, and you just keep your cash liquid and you keep it, you're getting decent rates from the Fed. It's, buy your I bonds, right?
Yeah.
And keep it liquid. And what we're going to see after the next leg down, so I firmly believe that's going to happen in the next year. I don't know exactly when, but what's going to happen after that is everything that didn't work for the last 10 years is going to start working. So I think it's small cap value going forward.
Now, let me push back
Yeah.
on that one. Is
Sure.
that don't these small cap firms need help from banks, and aren't they going to not get it? Or is that not small cap enough to worry about?
Yeah, I mean, I think that there's probably some truth to the fact that they're going to need help from the banks. But my sense is a couple things. First of all, a lot of them are producing cash flows right now. So they're not highly speculative firms that their returns come in the future, right? So they're going to be able to bank themselves even at higher rates, given that they have strong cash flow, right? Two, I think the government's not going to give up on that. They're going to make sure that the banks are giving money to these sectors after we had this downturn. So I think that, look, everyone's going to be challenged going forward. It's not, and I was going to talk about a little bit of the price of this, but the companies with nearer term cash flows are going to they're going to take the day, right? And I think international is going to be similar.
You don't think we're just the tallest pygmy out there? That
well, some ways we are, right? But I think international has been beaten down to a level that, anything good happens, it's great, right?
What region do you think is?
Well, I actually think so. I do want to talk about the price of volatility, right? After this, I talk about this, but I do think that in particular, emerging markets are going to be interesting because they don't have the high debt levels. If you exclude China, right? They don't have high debt levels, and they're used to dealing with inflationary environments. And a lot of them are commodity exporters, which is another area I think will do relatively well. But my caveat on all of this is that going forward, it's not a free lunch at all. Volatility is going to be something that all of us have to deal with. And it's going to be much more extreme than we're used to investing in Apple and Meta and the FANGs. Right.
Yeah.
We were used to that steady growth. That is not happening any longer. We are all going to be victims of volatility.
Yeah, well, our moods have been very similar. I mean, I used to say that I spend, and this was true, I spend more time figuring out which baseball players I want on my fantasy baseball team than figuring out what I want in my portfolio. But now I do worry about my portfolio, and I feel like I ought to spend some time And, at my age, I've got a very low tolerance for volatility. So it's,
Unfortunately, my message is, if you
have a
want,
nice day.
if you want returns, volatility comes with it. I mean, volatility comes no matter what you do, right? So
Yeah.
you might as well take the returns. I just don't see any other option, right?
Yeah.
And I think we're in for 10 years of that. And there's ways to make money, but it is not going to be fun in a lot of ways.
Okay, so I've interrupted you a few times. Are there any other thoughts that you want to get out?
Yeah, I mean, I think the other things I would say is this is a time that's going to be pretty pro-worker and anti-capital. I think many of us are going to be facing higher taxes coming forward. I don't think it's going to be crazy changes, but I think we're in a pro-labor, inflationary, food costs going up, energy prices going up, and just a lot of volatility. And I think, so like this period in the 70s and the 40s, I think we've been through these periods before. We'll survive it, but I just don't think there's any other way. We're not cutting our way. As much as you would love to see austerity, Arnold, there's no political tolerance for that. It's not happening. So and with a millennial generation coming up, they have no appetite for that.
Well, Macron's going to make it work.
Right, yeah, exactly. Well, I mean, just look, 2 years of retirement age and people are burning stuff in the streets.
Yeah.
So think about if you were really talking about cutting Medicare, Social Security. I don't know, my parents might be like burning down their apartment. I don't know. So I just don't think that's happening. So
Yeah.
this is what we got to deal with.
All right, I think it's time in our program to bring the audience in. So use your hand raising or whatever, and let's start with John A.
At the risk of betraying my profound ignorance, I'm looking at Federal Reserve Bank of. My question is about inflation, and I'm looking at the Federal Reserve Bank of Cleveland 2-year expected inflation, and it says 2.2%. So why do they say that? Whereas individuals I respect say we're going to have 4 or 5% inflation.
I can answer in a way, and then I'd love Arnold to talk about it in more of the economist way. I mean, I'm not an economist, right? So my take is we are going to have inflation levels plummet because the Fed's gonna, create an artificial downturn through raising rates. And 5 seconds after we stop doing that, inflation will bounce right back. And we don't have enough workers. We don't have enough anything else. And so I think that 10-year rate is delusional and based on short-term thinking on what the Fed's going to do right now. But I'm not an economist. I don't know, but that's sort of my take. I just don't see it coming down like that. But
I should clarify, this was a expected 2-year.
Yeah. So maybe, and I'm not going to make a prediction in 2 years. This is a 10-year prediction, right? That we can have rates go up and down, and as I said, it's going to be volatile. I seriously doubt in 2 years the inflation rate is going to be 2%, but it could be if the recession hits and that's the worst of the recession, maybe. But that's what I would attribute it to. I don't know, Arnold, if you have a different.
Yeah, I think it's irrational exuberance,
That's sort of my take too.
and sort of a what was the term that they used to say about the stock market when interest rates were zero was TINA, there is no
Yeah.
alternative. I think people's attitude is there is no alternative to medium-term treasuries and 2-year CDs. And so that's kind of drawing it. But I think they'll find that that doesn't protect them that well from inflation. There are two ways that inflation could end up, higher than what people expect. One is that we have a recession and it lowers inflation, and then there's no tolerance for the recession, and so it's like an airplane. I don't know if you've ever circled an airport and then you come in and the pilot just pulls it off, pulls up for whatever reason. Maybe the air traffic controller told him there was a problem, or he sees a sudden wind shift and he pulls off and takes off. That's kind of my picture of what will happen if inflation it might go down for a little bit, then it's going to take off.
Yeah.
The other thing is, I was not born in 1972, and we had recessions and we still had inflation, and that's another possibility, that we do have a recession and we still have inflation. I think in fact, as I was thinking through, kind of walking before this, I'm thinking, how do I reconcile my belief that, we're not going to conquer inflation with my belief that we're going to have a recession? And I think I think a recession could easily come from just the current situation with banks. I mean, we don't know as economists really how banking works. I mean, so, I sort of think that banks operate on kind of a Minsky cycle. When times are good, they're, they love to lend, and then when they all get when something bad happens, then they all, don't want to lend. And I think when they don't want to lend, the capitalist system kind of grinds almost to a halt, because a lot of small businesses need it. If you're trying to start a new business or add a project to an existing business, you don't have the money, and you just look around and you see all your fellow business people having trouble, and you say, well, I'd better conserve cash rather than invest in some new project. So I think it's possible in this kind of liquidity demand situation, where liquidity is precious, to have this sort of economy kind of grind to a halt, have a recession for that. And so I was trying to reconcile, well, okay, we could always have both. We could have, unemployment go to 5.5. We could have inflation still go up to 5.5. There's no, the Phillips curve, the economy doesn't know that the Phillips curve should exist. And in the 70s, it kind of forgot that. So,
I mean, the one thing I think is a savior, because obviously we see this going forward, is they're not any more 30-year-olds, and it takes 30 years to make one, right? So we're not having the kids, we've cut down on immigration. I mean, I do see, I have to say, I think AI is sort of, ChatGPT will be the productivity saver down the road. And it is the one thing that I look at and I'm like, wow, this could be a productivity, that and potentially bioengineering.
Yeah, right.
Like, these are
No, we could have geek rapture, right? We could
right,
have
right. So but these things are not going to happen in 2 years.
Yeah.
I can't get anyone in my company to use ChatGPT today.
And,
So
and Goldman Sachs and one other big bank just forbid
JP
their
Morgan,
employees.
yeah.
They forbid their employees to use
Right.
it.
So I
So
do,
the diffusion isn't going to be super fast.
exactly. So I do think that there are things on the horizon that could be deflationary, but they're just not going to come in any, reasonable time frame for an investor.
Okay, Tom, you have a question. You have to unmute though.
Yeah, thanks. It's great to listen to you. I mostly agree, though you didn't quite mention that another huge difference between the 40s and now is this demonstrable capital surplus. And one of the reasons we've been having, in my view, my analysis is that for the last 15 years, since the 14 years, since the 2006 peak of house construction in the US, which was followed only a couple years later, which Scott Summer thinks is a huge difference, but to me it was because of a lag. The reduction in house construction helped was the big trigger, small cask of fuel for the financial crisis in 2008. But we have a huge amount of capital in the world relative to the young people who are the type of people who need the capital. In the 70s, which I also grew up in, I'm only a couple of years younger than Arnold, there was the huge baby boomers coming online. And we haven't had that since, and we're not going to have that since. What we have now is kind of the demographic neutron bomb, where the rich countries don't have enough kids. You meant, and I had my question for you, Alan. I was just on a talk with a friend of mine, walking in Bratislava. He's getting an offer of about 20% more to go to another company. And I was telling him, you know, when I was in Silicon Valley, the rule was 20% or more you bounce, 10% or less you don't bounce, and between 10 and 20 you decide on the other things. And I'm wondering if you say you can't find people. Well, you're poaching. That's great. Are you offering 20%, 25%, 30%? How much more are you paying for them?
That'd be a good thing. You know, I don't have a definitive figure for what we're paying more. It's probably something on the order of 20% more than a few years ago. So I think that's certainly true. I guess the other thing I would say to your point is this massive capital surplus. You know, I think that's going to get inflated away. So I think it's going to get destroyed. And, you know, not completely,
so we're gonna screw the Chinese, and we're gonna screw the domestic savers.
old people, yeah.
Yeah.
Yeah, but capital to a large extent is also financial money available to invest. And so while the Fed is going to screw the savers by raising the interest rates, at the same time, we're going to have continued, as you mentioned, fiscal expansion. There is zero appetite. Sorry, Arnold, you know I disagree with you on this. There's nobody who's going to say, cut the budget. Trump got elected because he was a Republican who said, we're not going to cut the budget. We're going to spend as much as the Democrats. And by the way, my view is, if the Democratic Party doesn't say that there's a spending problem, there's no spending problem. And we're not going to cut the budget until the Democratic Party also says it's a spending problem. But that's
Have a nice day.
2, 3, 4
I'm not
elections
gonna hold
away.
my breath.
It's a catastrophe away unless we can have enough soft landings. But you know, you talk about the national debt, 100% in America. It's 250% in Japan. They've been inflating since their lost decade of 1990, and then the second lost decade of 2000, and then the third lost decade
Look at
of
what
the
it is in
2010s.
China. I
You
mean,
know, and China's going through a huge neutron bomb of demographics. They maybe are on the verge of having more deaths than births now, but Japan just had that. But you know, that's not such a huge problem, because you don't have more hungry people because of that. You have more lonely old people. So the problems are very
that we
different.
will steal money from. Right?
Yeah, but you know, my sister took her money out of her 401k and asked me, what should I invest? And I said, I don't think there's any good investment. So I was happy to hear that from you, but I'm also sad. I was hoping you would tell me.
Yes, there's this magical investment that you can get into that will protect you from volatility and increase your wealth.
And
I'm
we just
looking-
don't know what it is.
I just don't know what it is.
Yeah.
I'm researching
It's
feverishly.
unicorn farts. Oh,
Yeah.
by the way, one thing, I don't know if you noticed, oil is has been going down in price. And one of the reasons we have this inflation is because the oil went up in price. And increase in oil price and energy price looks a lot like inflation. And it hurts like inflation, but it's not the same as inflation. Even though to people's pocketbooks, it has the same, everything goes up in price, same effect as inflation. It's not quite the same.
So does anyone else have yeah, okay, Ernie, go ahead.
Yeah, well, I have two things to say. One, we haven't really dealt with the issue of the fact that the pandemic spending, the big gift to everyone, $2,000 per person, as well as the gifts to businesses. That was a massive shock. It was about 25% of GDP. And that stopped. That's not going on. Now we're back to the same kind of spending trends we had pre-pandemic. And that shock has to work its way through, which it is. And when it finishes working its way through, inflation will come down. It may not come down back to 2% or less, but it's still going to come down just because the shock is gone. I mean, you may have a different opinion about that, but that's
Well, the
the way
question,
I'm reading it.
the question is whether we've, the price level has gone up enough to kind of cover that. And I don't know, I mean, what I read is that, consumers at least, and probably true of a number of state governments, are still pretty flush with savings from that stimulus. So yeah, I don't know how that'll play out. I don't know if Alan, if you have a view?
I mean, yeah, I mean, I'm not a economist. I mean, I feel like once the expectations get a little unmoored and like, it's not just the stimulus and it's not just the things that we did during the pandemic. We also have regionalization, deglobalization. We also have a 3 point whatever percent an unemployment rate. I don't know. I agree that, yeah, like it's not going to be 9% anymore, but I just don't see it being 2% inflation. There's just too many forces in the economy that feel like, to me, I mean, certainly on a temporary basis, when you kill it with super high rates and the Fed causes a recession, you could get there for a little bit, but I think it's a beach ball that you're pushing under the water.
Okay,
Let me
there-
mention real briefly.
Wait, just a
that
second. Wait, I think Ernie had one more thing to say.
Yeah, I think one other thing that I had a conversation with the director of a regional bank on Friday at a get together for St. Patrick's Day, and I when he came
Was
in,
he
I
drinking
talked to him
heavily,
several
Ernie?
times. Pardon?
Was he drinking heavily that day?
No, he wasn't. I told him I thought about him all week. I wondered how he was getting through the week after Silicon Valley debacle, and he said he wasn't worried. And I asked him why. He said, "Well, we have all small depositors. It's not a big bank. It's a small regional bank." He said, "We have all kinds of small depositors." I said, "So you're not worried about a run?" He said, "Right." I said, "Well, that's why you want to worry about a run, is because it makes you realize your losses. And if you don't have it right away, you're still going to see the losses over time." He said, "Well, if we stay mark to maturity,
Hold to maturity.
hold to maturity, there won't be any losses." I said, "Well," I said, "if you're paying 5% to keep your depositors and you're earning 2%, aren't you losing money? Won't your book value decline over time with that?" He said, "I hadn't thought about that."
It's-
You better.
I mean,
because
Yeah, that's very common. I mean, I was going to comment on that, that
Yikes.
this whole hold to maturity idea, I mean, it's very hard for me. Like, you know, the most important event of my early adult life was the savings and loan crisis. And, you know, I mean, interest rate risk is like, you know, baked into my soul or something, because I mean, I have never forgotten it, and have, you know, and it's like everyone is acting like none of that ever happened. And this hold to maturity, no, you're right, it's crazy, especially if we have a ratchet up of inflation and interest rates. You know, if we go to, you know, inflation of 10, interest rates 5. Again, we don't expect that to happen the next 2 years, but you can't rule it out sometime down the road. And so, yeah, by the time your hold to maturity assets mature, you could have had everything wiped out. You know, if you're paying, you know, if you're losing, I know it's hard to do arithmetic in real time, but let's say you have $100 bond and you're losing, you know, let's say $10 a year financing it, you've lost the whole value of the bond in 10 years. And if it's a 20-year bond, I mean, you've been long dead by the time it matures. So anyways, that's
And I would
little-
say that almost every bank that isn't, I guess, a money center has got to have something like that going on to some extent, right? If it isn't that, then it's commercial real estate loans, or their loan book can't. I mean, there's no way they were
Yeah.
able
Back,
So that, yeah, so they've
back
got
in 2000,
credit risk on their loan book and an interest rate risk on their securities book. And it's, oof.
and we haven't seen the credit risk really hit yet, right? So I think that's going to come as the economy goes down.
Yeah.
And so, you know, unfortunately, I think the government's just going to have to subsidize the banks and turn them, like we said, into utilities, and make them buy all the treasuries, and you know.
And then, but as they go more into treasuries and less into loans, then, you know, there goes your commercial real estate, there go your other, you know, business assets. So
Well,
it's
and I think
not a clean way out of it.
it's not, no, it's not clean at all. And like I said, I think that the private side is even worse. It's going to be, but that's, you know, you have 10-year lockups on these funds on the private side. So these guys are going to earn 2% on everyone's money for the next 5-10 years, well, and then produce nothing at the end. So it's going to be a massive destruction of capital.
So Tom, did you
Well,
still have a, you actually
Yeah,
wrote it.
I wanted to mention, back to Ernie's point about the stimulus working its way through the system. One of the things that's happening, that I just read today, is there's multiple states in America reducing their income tax rates to attract the newly available, you know, Silicon Valley engineers that are being laid off, that are making 100, 200,000 bucks a year.
Anyone
They can
told
go to
Maryland
Tennessee.
about this?
Well, I don't think
I don't
Maryland
think
was
so.
on the list of reducing, but
trying to raise
Kentucky
one.
was, and a lot of others.
They're trying to raise Arnold.
Yeah,
Madison.
you know, we went from Larry Hogan, a rare Republican, to a very normal teachers union loyal Democrat.
Yes, we have. Yes,
Yeah. So are you on the Maryland
Here-
side of the district line?
I am.
Yeah, well, I guess you wouldn't be any better off on the district side. So,
No, that's for sure.
yeah. Yeah. Anyone else that hasn't spoken up want to speak up? We only have a few minutes. I figured we'd do this for an hour. I mean, is everyone just sitting there in stunned silence?
Well, one other thing I was wondering, you know, and I put it on the link,
Should we
UBS.
short things?
Yeah, how to short things. I put that in the chat. You didn't talk about UBS buying Credit Suisse, which happened today. And, you know, the thing is, you're thinking there's going to be bank problems, but I'm thinking the government is going to pay whatever's needed, deposit insurance that's unfunded, pushing rich banks to buy not so rich banks that have problems to avoid any crises. And as long as they avoid the crises, they expect to get reelected, and they're pretty good on that expectation. I mean, the theory of democracy is they do the right thing to get reelected, and sort of if they get reelected, that means they're doing the right thing. That's the sad reality. But they're going to do inflation to avoid the recession and higher interest rates to avoid the inflation. And there's going to be a strange mix.
They're gonna kind of.
I also wonder, like right now we're seeing, credit Suisse, credit sus, as I've heard it called, my kids would call it, and Silicon Valley Bank and Signature. Like these are all idiosyncratic sort of things, right? Credit Suisse is,
Credit Suisse is not that idiosyncratic, but
well,
it's a European thing.
I don't know.
In America, everything in Europe is
the level of
exotic.
criminality might be at a higher level, and then crypto and this, but I just think that that's what happens first, right? Like as things get stressed, it's the idiosyncratic ones that go first.
Yeah, they go first, but with the deposit insurance at unlimited rates, that is going to stop the bank runs. Everyone's going to get their money, so there is no reason to take your money out of the weak bank.
Is there though? I mean, Janet Yellen didn't exactly say they're going to back up everyone.
I think for deposit insurance, they
I think that-
basically said that.
Yeah,
Just
I
not gonna.
She said no to the senator from Oklahoma.
Yeah, that's what she said.
But right, yeah, we're not going to back up your bank. We're going to
Yeah.
back up the
Your
bank.
oil and gas bank, we don't like that one.
Yeah.
You'd be interested to read John Cochran's column. He has references to a study there about the equity loss, the bank capitalization loss because of the interest rate rise. 96% of the bank's capitalization in the United States disappeared with the higher interest rates from the Fed.
Oh yeah, that was one thing I wanted to mention.
I didn't read it as that. Well, yeah, those guys did have a very big number. I thought I'd heard that only 600 billion was lost. They said 2 trillion. And if it was 2 trillion, it is 96%.
They said 20. If you go to 10% of if you get 10% of their asset value disappeared, and the leverage was such that they had about 10% equity, all of it's gone.
Yeah, that's the pay.
All gone.
Yeah.
Mr. Pentz, would First Republic Bank qualify as idiosyncratic, or would that be the step?
I am not. Well, I am not a bank examiner, so I don't really know. I mean, I guess what I would say is it seems like a more normal bank, right? From what I've read, I only know what you've read, and I guess what I would say is it starts with the idiosyncratic and then moves into the everything.
And
everything goes down.
And the other thing is lots of banks could become idiosyncratic. That was the zombie savings and loan phenomenon, which if you go by the theory that everyone has forgotten the 1980s, then the regulators will just be asleep while these underwater banks just take their money and go to Las Vegas with it.
It should be good for small cap value, though.
Right. Yeah. So some of them will win, and their executives will get nice bonuses, and their shareholders will get nice returns. And then some of them will lose, and it'll wipe out the deposit insurance fund. So, have a nice day. Any other final thoughts, Alan, before we wrap it up?
Small cap value. Just
okay.
Wait for the next leg down and then go all in.
Okay. All right. Okay. Well, thanks everybody.
I don't know whether to say thank you, but this was brilliant.
Okay.
Oh, thank you. It was a lot of fun. Love talking to everybody. So.
Okay.
Oh, and Alan, you do have a Substack?
Yeah.
What's it called?
thenewrules.substack.com.
Thanks.
Or you can just Google Alan Pentz Substack, and I'm sure you'll get there. Okay, thanks,
Appreciate it.
everybody. Okay,
Bye,
bye.
everyone.
Thank you.
Thanks, bye-bye.
Bye.
Okay, bye.